Good afternoon, everybody. Thank you so much for joining us. This afternoon, we have a great panel. We're here to talk about CMBS and structured finance and distressed real estate debt strategies. In the room with us, we have Lonnie Hendry, who's with Trepp, Bryan Shaffer, who's with George Smith Partners. Myself, I'm with CPS, and Stacy Stack-Rudolph, also with CPS and Stack Solutions. We'll have everyone do some introductions in a moment. But we're here to talk about the state of just generally real estate, with a focus on the stress side of real estate, with a more niche focus on CMBS, but glad to address any part of it. So just to give people a little background, so Lonnie focuses on the data side of things, tracking loans, tracking bonds, tracking the market. Bryan's an originator and deals with new borrowers of loans and is constantly exposed to the market as to what's going on. I'm a real estate investor, and I also advise borrowers when they have distress or potential distress coming down the pike. And Stacy is my partner in the distress business, where we advise borrowers, but Stacy also works on behalf of lenders. Lonnie, Stacy, Bryan, thank you so much for being here today. We've been marking this for a while. No pressure. The crowd's coming in, so we'll wait a second for intros, but I really appreciate you guys taking the time to join us here. And this is part of a larger series that we have called the Borrowers Roundtable. We attempt to talk about things that there really isn't someone to talk to about, right? So if I'm a lender and I'm lending, I could go after my remedies. If I'm a borrower and I need to solve a problem with my loan, I could call my mortgage broker, but he deals with it on just going in. I could call my lawyer, but he really marks up docs and deals with case law. I could reach out to asset manager, but if I hired the right asset manager, he would have some exposure. But there's this lack of familiarity generally with the underlying documents of CMBS trusts and how other lenders work, that make it difficult at times for a lot of traditional asset managers to really understand what we are, what goes and what the process would be, so to speak. So with that, I'd like to start the intros. Let's go left to right. Lonnie, can you please introduce yourself to the crowd?
Yeah, thank you so much. I'm really looking forward to the discussion today. And this is my first Clubhouse meeting, so I'm really excited about that, adding another thing to the tool belt. So my name's Lonnie Hendry. I work at Trepp. We track the securitized debt market. So we look at U.S. private label, conduit, large loan, SASB deals, as well as the agency, Fannie, Freddie, and Ginnie. And then we track the commercial real estate collateralized loan obligation space as well. So have a really wide swath of data related to property performance, line item financial type of data, as well as bond level performance metrics as well. And for myself, about 20 years in the CRE industry, varied background. I worked in appraisal for about 14 years, did property management and development for the first 4 or 5 years of my career. And I also teach as an adjunct professor at Texas Tech University. So really looking forward to the conversation today, and thank you very much.
Oh, thank you. What do you teach at Texas Tech? What's the focus of what you teach over there?
Yeah, so I teach 2 courses there. I teach real estate fundamentals, which is a entry-level real estate course, and then I teach real estate appraisal to the upper-level undergraduate students.
That's great. That's great. And practically, what would you say? Working at Trepp, what is your what's your day to day like? What are you looking at? What do you get into the office try to focus on, and what piques your interest on an ongoing basis?
Yeah, so I have a pretty unique role at Trepp. I head up our advisory services team. So I come in to play where our products maybe don't fill the niche for the client. And so I kind of supplement our traditional front end SaaS products with additional subject matter expertise or deeper dive into our data more customer bespoke type of opportunities. And so the stuff I like are really trying to find what the story the data is telling and how you can make that actionable and see an ROI as a user of our platforms or a user of our data.
That's great. That's great. That gives you a really, really great perspective because you're not just interpreting data for what it tells you, but you're digging deeper and trying to investigate what's going on behind it, so actually people could use it and make money with it. That's great. Thank you, Stacy. Good afternoon. Can you please introduce yourself to the crowd?
Thanks, Shlomo. Thanks for having me on. I have been in the industry for about 20 plus years, and I've played all the roles of everything from lender to investor to asset management to distressed asset management to servicing. And so I have a wide array of experience, just enough to cause trouble on all fronts. Stack Solutions actually offers a concierge level of service to investors, lenders, principals, and asset managers. And what I like to do, and how I'm also involved with Lonnie and Trepp, is I love to use their data, which is very clean, very transparent, in non-traditional ways, and have had a long standing relationship with them over those decades. I think their service is fantastic, and it's one of the here I go. I'm fawning over Lonnie's service, but it's a great service that provides a lot of data. So we do everything. We touch everything from actually touching the property with site inspections, lease abstracts, underwriting, and then as you highlighted, I help you on the side of the workouts with regards to clarification with servicers and strategy on that front as well.
Great. Thank you so much, Bryan. I guess it's still, is it still morning for you? Yeah, it's still morning for you. Good morning to you and good afternoon to us all on the East Coast. Please introduce the
No,
crowd.
good morning and good afternoon. Yeah, it's 10:07 a.m. here. Bryan Shaffer. I'm with George Smith Partners. We're a Los Angeles based, capital advisory firm. We basically help, buyers, owners, and developers of commercial real estate, secure the financing for their property. And really, I think we wear more of a consulting hat where we get paid, when we place the financing and the deal closes. But most of our process is helping the borrower understand, the best capital for the project, making a market for that capital, structuring it, and getting it closed. So there's a lot involved. I always say that, some people, try and do leasing themselves and they burn themselves. And it's the same thing with doing a loan yourself. I mean, there are loans available and people can sometimes find loans, but if you get into the wrong process, you really get burned. So what we try and do is find our borrowers the right loan. I've been doing this for 32 years now, 33 years. Tomorrow's my birthday, so everybody be nice to me today. And I also I teach I'm a guest lecturer at USC. I teach a class on CMBS, which is sort of relevant. And and I would point out to people today, because really CMBS is a little bit less active than it has been in the past, but it's starting to become more active. But CLO market, which everybody referred to earlier, the collateralized debt obligation market, where it's more bridge loans that are being secured, is super hot right now. And I just closed a $47 million CLO loan 2 weeks ago, and we're just seeing tons of activity in that sector. So Shul, that or Shlomo, I'm sorry, that would probably be the next step for you is working out some of those loans. Unfortunately, as that market just starts to explode, there's always problems. But we are seeing a lot of activity on that side, and CMBS every month is wrapping up. For people, I don't want to ramble on, but people interested in CMBS, the key right now is you could get 10-year interest only money in the low threes on most transactions. The leverage isn't as high in the past, but it's very attractive. And then the CLO market, you're looking at bridge loans, LIBOR plus 350 to 450 in that range. So there's just a lot of options.
That's great. That's great information. So first off, happy birthday. Um, Glad you turned 21. Now we can have drinks.
Perfect.
And and secondly, that CLO stuff is really interesting, and we should probably talk about that. Sort of like what's the impetus behind a lot more CLOs, and I'd love to get into that a bit. Um, Lonnie, I did want to start with you and sort of see if you give us a little overview as to I mean, generally the CMBS markets and also, well, generally securitized debt markets. What's happening? What are you seeing on the new origination side? What are some lender hot button issues? And what properties are in favor, what properties are not in favor, and sort of some of the thought process that you're hearing from your clients.
Yeah, I think that's a great segue. So to give you a couple of high-level bullet points, and we can kind of drill down from there. I think Bryan hit the CRE CLO stuff on the head. So if you look at 2019, that was the all-time high in terms of new origination for CRE CLO. And in 2019, there's about 19 billion in total issuance for the CLO market. In 2020, due to the pandemic, obviously, that number shrunk down to about 8.7 billion in 2020. But just through the first 7 months of 2021, there's already been $24.5 billion worth of issuance. So to say it's on a torrid pace would be an understatement. It's really in uncharted water. Those loans are 24 to 36 months generally in term, with usually 1 to 3 12-month extension options available to them. Most of them are story loans, so they have some sort of value add component or redevelopment component attached to them. So they are definitely a little riskier, but there still seems to be a really, a good appetite for it on the secondary market. As far as like the traditional CMBS, I think I would agree with Bryan as well. We kind of hit a lull in 2020. The market shut down for a few months when the lockdowns went into place. And so, just at an aggregate total perspective, the private label market in 2019 had about 98 billion in issuance. In 2020, that number was only 59 billion roughly. And we're already at 58 billion in 2021 through the first 7 months. So definitely seeing a comeback in the CMBS space. The agency space has been pretty much, consistent across the spectrum, just because they didn't really see a slowdown there. There were some additional reserve requirements that were put into place when COVID first hit on the agency. So we're going to see, 12 months P&I reserves on the front end of that deal. And so, I think we're really kind
Lonnie,
of
you broke up. The 12 months P&I would be on an agency deal
on
reserve?
on the agency side. On the private label stuff, we didn't see anything quite that dramatic. And I would say the appetite has really come back strong for the CMBS market. So there are a couple property types that obviously have fallen out of favor. Pretty tough to get retail or hotel financing unless it's a really good deal in a really great location. But for industrial right now, that market is incredibly hot. Delinquencies at all-time lows. Multifamily has been stable. Office, I think, is interesting. We can probably talk about that a little bit through the call today. I think it's survived the first, call it 18 months or so of the pandemic with, not a whole lot of disruption, but we're starting to see as submarket or sublease space in certain submarkets have become prevalent, a softening in those rental rates. And so it'll be interesting to see as maturities come up on those, what happens in that property type. So, hopefully that gives you a pretty good little synopsis. Happy to answer any additional questions or go through a little bit more granular if you'd like. But I think we're looking good heading into the last part of 2021. And I would say that at this point, all things seem to be hitting on all cylinders.
Very, very interesting. I'd love to dig down on some of that, but I think the topics you've hit on are a perfect segue. So Bryan, I mean, some really great data Lonnie threw out there. Um, can you sort of talk a little bit about some of the new loans and trends you're seeing, sort of along those lines, like bring it, to Main Street, so to speak, a bit?
Yeah, really. I mean, and I think we're all talking about the same thing, but it's really just this bridge loan market where somebody's trying to do a value add. Property I did in Houston was a sort of C asset that guys are buying. They're going to renovate, a good portion of the units, and then 2 to 3 years from now, they want to move that into a permanent either CMBS or Fannie or Freddie loan. So the goal of these loans is just to give people the capital to make improvements, add value to the property, increase the NOI and the debt yield of the property over the 2 or 3 year period, and then sell it off. So it's a whole different program. And I would say the borrowers, in the most part, probably just think of it as a bridge loan. They don't even know it's a CLO loan. But there is a lot of people out there trying to do value add to properties, and it's somewhat hard because values are so high. So you're paying, good price going in, and then you got to increase the value, and then come out and have a more valuable property. And so that overall, that's where the market's been, is that a lot of people are working on value add. People have been avoiding CMBS if they can, just because of all the past problems. And several of my clients, as I've talked about, Shlomo, had special servicing issues that they had to work out. And so there's sort of a negative connotation to a lot of, my clients, at least with CMBS. But ultimately, if you want to do a retail loan, if you want to do a hotel loan today, and you want somewhat attractive financing, the CMBS market is the only way to go. So I think in the next year, we're going to see CMBS start ramping up more. But this year has really been the year of the bridge loan, and there's been lots and lots of people in that space. And the way they're using the CLOs is almost like a piece to their loan, so that, because on you have the renovation component, which you can't securitize. So what they're doing is basically building in an A part of the loan by using the CLO, and it allows them to lend a lot more on the bridge side.
Interesting. So, Bryan, so this CLO boom, and just to preface before I ask the question, to give a little color for everybody. So essentially, um, CMBS is when a bunch of different banks make loans and then they package it together and sell it to a third party trust that then um, sells off the cash flow to bondholders, and the various bondholders have different levels of decision making control, and the ultimate, or the day to day person overseeing it is usually totally a third party. And I think the CLO side, you may see some of that, but a lot of it you see where it stays under the control of the company that actually originated that CLO. But the thing about bridge loans and CLOs is that, whereas if you're taking a permanent loan, you have to underwrite, the loan has to underwrite and be stable and has to be able to support the cash flow. A CLO, you don't have to have great cash flow in place. It could be an upside play, um, like a bridge loan. And well, I don't know if these are rules around CLO, but they are how they essentially shake out. So most of the CLOs will be bridge loans. So I guess, Bryan, I guess my question is, do you feel that the push to CLO loans has to do with the fact that so many properties have declined in value? Do you feel it's because institutional capital is now looking more at value add, whereas previously they were looking more for stable? Or do you think it's just that, the stable loans have looked elsewhere besides for CMBS, so therefore CMBS has declined, and CLO now has maybe picked up and been, the place where many people are looking to, to basically find a quick in and out, so to speak, like, or another option. I'm just curious what you think this drive to CLOs, what's behind it.
Yeah, and it's a couple things. I mean, first, the market's really changed where everything is focused on multifamily and industrial properties. I mean, there's like medical office and self storage. There's some segments that have done well, but I think everybody always looks backwards. So everybody looks at the COVID period and says, office buildings, we don't know what's going to happen. Retail, we're worried about, and hotels, we're completely afraid of. So it's focused all the capital on just the smaller segments in the market. So if you're going to get into multifamily, you have sort of two choices. You could buy a permanent loan that's a class A loan and just hang on to it and collect cash flow, or you can buy some type of older property and add value to it. And really, that's where the capital has been, is encouraging people to buy those existing properties and add value to them, whether it's multifamily or industrial. So I think those factors have driven people to this bridge part of the market. I think there's also, as you pointed out, I mean, most of the debt being originated on the multifamily side for permanent financing that would compete with CMBS is Fannie and Freddie. And it's a lot more flexible, and a lot of people view it as more attractive, even though, a Freddie Mac loan is basically a securitized loan that's very similar to CMBS, but just the way it's serviced is a little bit more friendly, and it's made it a more preferable product for buyers and developers. So I think that's driving it, and I think there's also just a lot of views in the market that if you can find this multifamily that hasn't been operated right, and you can you can operate it correctly, then you can have a home run. And that's led to the lenders having a lot of capital in that market as well. And there's a lot, because of the term, there's a lot of flexibility, so the bondholders aren't stuck in as much. And what's basically happening is, it's just adding liquidity to the bridge market. So instead of having to go to a bank and set up a line and have these rules for the line, they sell off, a portion of the loan that's very similar to CMBS, but they're just selling off a lower portion of the loan. They're keeping the higher portion of the loan. And like you said, they're typically servicing them that self. Sometimes they're still going to go to a master servicer like, Wells Fargo, and they're going to be the special servicer, but they're still going to deal with those construction issues usually directly. They're not going to sell those off to a third party servicer. So I think it's a bigger change just in how people are looking at product, and that there aren't that many good perm options for retail, office, and hotels right now. So it's driven everybody to this little segment, and they have to figure out how to play in that segment.
Very, very interesting. Thank you. So, Stacy, as someone who's had many years' experience working in house on the servicing side, has been on the origination side, um, now does work. When the lenders need someone to really, get their hands or help get their hands around a property, and they call you, and obviously you have exposure on the workout side, where I think what we do is like, you know it's so not it's most of our job is not even negotiating. Most of our job is just trying to sort of get both sides to see what's really happening. That the borrower shouldn't think that the lender doesn't give me a deal because he doesn't want the property, and think they'll get some ridiculous restructure of the loan from the lender, and for the lender to understand that there's perhaps more to the story. So you see so much from all sides. I'm very curious if you could talk a little bit about servicing, about asset valuation, and also, if you will, now on the topic of CLO, working with your lender, if you have a CLO versus a CMBS loan, versus if I went to my local bank and worked with them. If you just give us like a little way to land on what you're seeing, and sort of bring home a lot of the points that Lonnie and Bryan have made, I think that'd be great.
I think I can circle back. So we do quite a bit of underwriting in the bridge space. Uh, it's as Bryan alluded, and Lonnie, it's just exploding like crazy. With regards to the flexibility, it's kind of it's called a bridge loan, but it's kind of a bridge between your local bank that is going to be extremely pretty much relationship driven. But maybe they can't take the level of risk that a bridge loan could offer. Maybe they can't give you the level of proceeds that the bridge loan can offer. And then, like you said, the range, speaking into the agency and the CMBS, those are both much more fixed, much more less flexible with regards to just conversations and how you're gonna deal with the individual borrowers. On the CLO front in particular, it's really interesting to see where that asset is managed, especially when you get into a situation that maybe you didn't perform to the plan that you had on the books when it was underwritten. There are now new hurdles that are being underwritten as they put those in place, where there are clawback of funds or hard stops on funding of advances. Lenders got very smart about that after some of the stuff that they saw in the beginning. So debt yield hurdles, construction occupancy hurdles. Usually, it's been pretty interesting. I think Lonnie would have some thoughts on how you surveil something like that and watch that as a servicer.
What
Because again,
what does surveil mean? Could you elaborate on that point?
sure. So as you guys are, as they highlighted, a bridge loan is pretty much 24 to 36 months. And so when the bridge programs were first taking off back in 2019, what we heard from the banking side or the lender side was, well, this is great, and it's a very flexible product. It's a very interesting product. They were putting it into additional structuring. So a lender can either keep that on their balance sheet, which many times is secured by a line of their own line lending that they receive from banks, or they can go ahead and put it into a type of structured vehicle similar to CMBS but with more flexibility. And in the beginning of all of the world of CLO, it was they had managed versus static. And what that meant was that they could rotate those loans in and out of those structures. And so what was very interesting is, we didn't have a hiccup in the beginning, but there was the question, at least in my mind, coming from distressed background, when, because these are all, they're all upside, they're all changing. That's why they're not in a fixed environment also. And so one thing to look at is whether or not your asset has been rotated into that structured vehicle. Because that it doesn't mean your lender can't work with you, but it just kind of demonstrates, what they can do, what they can't do, because that has been put into a vehicle where there are certain thresholds that have to do with how things waterfall down. In other words, if you miss a payment, how does that affect the overall payments of the structure vehicle itself? And so there was a lot of question with how do we watch that, because these assets are moving every month. I mean, oh my goodness, we've done everything from multifamily to retail to office on this front. And so when you think about it from an underwriting perspective or an operator perspective, you're basically have a pretty fixed plan with how your expenses are. Really, the things that are running are going to be your occupancies. What's happening. You might have some CapEx stuff that's changing because you're changing the footprint, of the plans at hand. Maybe you're upgrading the property so that you can lease it up. But our big question was, everybody said, oh, you can't. Well, a simple rent roll, because when you underwrite these, again, as Shlomo said, it's not that your expenses aren't going to grow. It's all on the revenue side that's really making the big move into it. So you asked how to surveil it. Well, that's where there's sometimes a black hole, because there's in our typical world of CMBS and agency, there was a reporting timeline. It's a look back. You don't get financials until 3 months after they're almost done. And so it's by the time an asset's broken in the CLO world, if we were using those same standards, it's too late. What else did you ask me? You asked me something about the
Now,
banks.
if you could contrast the different types of servicing approaches between those that manage the CLOs, the CMBS special servicers, your local banks, and how that practically, and some of the practical implications you've seen.
It's pretty interesting. I think that a lot of times you'll see in a lending or a servicing environment that you have people that maybe are a little bit more advanced in concepts on those that are working the CLO. It's more like a balance sheet, again, type of asset. That said, the shops that I know that I work with, sometimes you'll get the CMBS guys that have worked CMBS for 20 years, and they have a very definitive script. And sometimes it can be difficult to find the middle ground between you as an operator saying, well, wait a second, this is the best plan for the asset. This is what I want to do, especially if you don't understand your documents and where your constraints are. We saw a lot of that in the hiccup of COVID and or the ongoing. We're going to see more of that in the office space, like Lonnie alluded. The other thing you see sometimes is with the CLO space, because it is so close to home, you are going to have the lenders themselves, like Bryan said, also servicing it themselves. So they want to keep that borrower relationship because they want to be the next debt provider with regards to when that does hit hopefully all of its hurdles and need to exit out of that bridge lending. So I think sometimes you have a little bit, I don't want to say easier path, but it's just versus the CMBS, the lender's hands are tied to in CMBS. It's just, unfortunately, it's a great product, like Bryan said, for rates and proceeds, although we are seeing a little bit of pullback on that front. But you have to understand the constraints as a borrower as to what your challenges are, whether who you're talking to, and what your documents and the structure itself are constraining you from. I don't know if that helps or if that's too cryptic.
No, I think it's absolutely great. So, guys, I'm gonna open up the hand raising now. For anybody to raise your hands. If we don't recognize you, I will say that it'll be hard to bring you up unless you have a bio. Now, before we move on, so as you guys are aware, um, on a daily basis, I'm dealing with borrowers who are pulling their hair out, dealing with CMBS special servicers, and often they're pulling their hair out because they don't speak the same language. Imagine going to some island with an unknown language, landing there and needing water, and you know not being able to talk, right? And it's that difficult because it's so complex what can or cannot be done. You may not hear from your servicer for 2 weeks, and you may think that, okay, he's just not returning my calls. The reality is he's going through layers of approvals and conducting third-party reports and things like that. That being said, I cannot help but attribute some of the decline in CMBS to what Bryan has said. So when you work with your local bank, there is a very high level of customer service. There's a relationship, right? So obviously the banker doesn't have any reservations about, being a little more vulnerable to you and not taking always a legal line with you. But when you deal with a special servicer, they don't know who you are necessarily, and they're not going to compromise their legal position, understanding that when a property is in distress, it could get pretty adversarial, whether outwardly or otherwise. But the net result over here is that the customer does not feel like they're serviced, if you will. In reality, the special services customer is the bondholder. It's not the borrower. So that is in my opinion, a massive challenge in CMBS. Where, I mean, Bryan alluded to it, and I'll just editorialize here for a second. I'm pretty certain that often he's had 3 term sheets on the table, and the CMBS was taken right off the table, and like saying, no, I don't care what the benefits are. I once had an issue, or my friend had an issue. I was talking to a guy who told me, so to speak. So those are issues as well. So with that, there's a couple of questions that are back channeled. Andrew, I know you had a question. Clarence, I know you had a question. So feel free to raise your hand and come up. Okay. So I'm going to call up to people here. First off, Shane and Jeff. But just bear in mind, there's a recorded room, so everything you say will survive in perpetuity. Pressure. There we go. Shane, good afternoon. If you guys don't know Shane is very active on the single family as well as the smaller multifamily space, and is someone that I've become friendly with over the past year or so. So, Shane, please do a quick introduction and also ask your question uh, pointed at someone, ask a specific question, and what's up?
Shlomo, thanks for the stage. Great content. I've definitely pinged and punched a bunch of people in here, and they love what's going on. I'm getting back channeled. Stacy and Lonnie, Bryan and Shlomo know, but Dream Team creates a lot of high-level conversations on Clubhouse about market trends for real estate, from an integrated perspective of private equity, syndication, single family, all the different spaces. Um, so that's JM and I. Shlomo's definitely one of our core moderators in that group. There's a bunch of people in the audience right now that are in that group. Most of the people that are in the room that are not new to Clubhouse. I've spent a lot of time with them on stages in real estate, and they're brilliant. But I think one of the things that I'm curious about, especially having some of you guys on stage, is I feel like the new creation of a lot of syndication capital has rushed to place itself in a compressing cap environment. So for multi-unit, I don't believe the underwriting is as strong, and I do believe a lot of the GPs, while the banks might think they may have good resumes, are actually playing in a new pond and new pools of asset classes that they don't really understand. So I believe they're out of their wheelhouse and pressured to place capital, and that a lot of their underwriting and cap expectation is not going to pan out, and it's really going to mess up kind of the IRR. What do you guys think as to how long we'll see this play out? Do you have any sort of sense of what you're seeing on a macro level of what kind of bad performance is coming down the pipeline? By the way, of future bad debt in that space. I was also kind of wondering, because the CLO stuff to me, Bryan, is kind of new, and Lonnie, you seem to have a lot of the stats on it. Is that kind of maybe? Do you think a lot of this new syndication is looking for CLO because it's easier to get than the other debt? Or, I mean, help me understand this a little bit, because I think it's a fantastic conversation, Shlomo. I think it's so strategically needed, and I love that you brought it to Clubhouse. So anyway, that's kind of my general.
Yeah, and Shane, Slomo, if you don't mind, I'll jump in on the CLO side. I would say that most borrowers don't even realize what CLO is, and they're doing a CLO loan, that they just think they're doing a bridge loan. So they don't even know the difference. And it's really how the lender handles that capital on the back end, like how they're putting together their capital stack on the loan side. And so it doesn't really impact borrowers that much. It's going to be interesting. I mean, there's a lot of big players that are very qualified and have done these type of deals before. Um, it's they're looking for properties. We like to use the word debt yield. So they're looking for like a 5 cap rate on the loan going in. So most of these loans, you've got to have some in place cash flow. They want you to get to, an 8 debt yield over the next 2 or 3 years before you exit. So you're basically taking a property that's not stabilized, but it's not doing horrible. It's getting a little bit of cash flow. It's probably cash flow positive day one. And you're creating it where it's going to be that leverage amount for the entire loan. And so it's sort of a questionable space if all the sponsors are going to be able to hit their targets, but it really just depends on the underlying market and the multifamily. It's a really tricky market because there's still a lot of people out there that aren't paying their rents and that are on some sort of eviction moratorium. And I don't know if borrowers are fully honest about how many people are in that position, but we do see a lot of people not paying, and that really seems to be the biggest issue on these loans, is that they were performing 2 years ago. A bunch of people stopped paying. People are coming in and buying them, but they're buying them at fairly aggressive prices, and then trying to correct the current problem in the rents and also increase the rents. And so it's a big pull for these groups. And so I think overall the margins aren't that big that they need to achieve. So we'll have to see how it plays out. I mean, it's going to be really interesting how many of these get stuck where they can't finance out because there are these hurdles to move to, permanent financing.
I think there's, Bryan, I love everything you said. There's one other thing that's even more concerning about that, which is, especially in the Midwest and North South areas, they underestimate, the performance matrix. Not only are they bad, the problem is that there was a culture that just was created in the Midwest to be able to get these people back on track, and that might be unwinding through Corona. And Lonnie, I love that you have a property management background. Just for, I did several hundred and then a couple thousand as an operator, entrepreneur for 2 different groups in West Michigan. Easily have 2-3 dozen phone numbers of, probably collectively, I don't know, 20-30,000 units of under management across the Great Lakes. So we've had some consensus opinion about this through Corona a little bit, and there's way more concern than Wall Street is letting on to, as far as what performance is going to look like coming out of Corona, especially in the CC plus space. And I love, Lonnie, that you were a property manager, because you're going to understand that it's not always simple as the math implies. But I'd love to hear what you got to say.
Yeah, I think all of the topics you've hit on are hot button items for me. I mean, I think it's a tale as old as time. History is not indicative of future performance, but it usually repeats itself. And I think we're seeing that play out now. So we're pre-pandemic, we were about 10 years into a bull cycle, that generally lasts 7 years. So I know I was at the MBA conference in San Diego right before everything shut down in March of 2020. And the optimism there was like through the roof, even though on every panel it was like, what inning are we in? And everyone said we're in a doubleheader. So I think the reality is sometimes people forget that, the cycle hadn't corrected itself since the great financial crisis. COVID kind of hit the brakes a little bit. And what that did, in my experience and what we've seen, is generated this optimism of distress. And so there were a ton of debt funds that were raised, there were a ton of capital, deals that were put together. And what we've seen is there's not enough deal flow to satisfy the capital that's available. And so you're seeing these, what everyone's calling a value add opportunity. But in my experience, value add means that there really is a tangible, quantifiable value add component to the real estate and the operations. And what we're seeing is when you're buying things that are stabilized in secondary or tertiary markets at sub 3 cap rates, and they've had 6 years of rent growth, like I don't know where the value add really is there. And so, from a property management perspective, you throw in the eviction moratorium, you throw in all these other, ancillary things that are just, you know, generally not part of the real estate conversation but have to be factored in. Nobody really has a good way to quantify that in their underwriting. Like they don't really know what the lasting impact is going to be on that. And so it's really interesting. Like I think to your point, a lot of people are very optimistic on multifamily specifically. if you look at the number of units that are being added, like sure, you can make the case there's not enough housing, there's not enough affordable housing, workforce housing, so there has to be opportunity there. But if you look at all the capital that's been placed at the prices it's been placed at, I think you're going to see some markets that, in the next 2 to 3, 4 years are going to really struggle to meet those goals. And then we'll be having the same conversation of saying, what are the lenders going to do in that instance? Are they going to take the properties back? Are they going to work with the borrowers? And so I think it'll be very interesting to see. But I would agree that, it's not all, roses from here. I mean, I think there's a lot of stuff that has to be fleshed out. And a lot of this is new to the market. The government intervention, the eviction moratoriums, those are things that we haven't dealt with as investors, operators, managers in the past. And it'll be very interesting to see how that kind of puts itself back in the marketplace once they go away.
And the kind of piggybacking off what they said, because I'm in the underwriting all the time on this stuff. We just finished
Yeah,
a
and Stacy,
portfolio.
by the way, Stacy,
Yeah.
I'll introduce you. Like Shane, if you want to, if like some of the questions you're asking, Stacy actually visits these properties as well before the lender makes a loan. So, and also asset manages multifamily. So Stacy's like the perfect person to answer some of the remaining questions on it.
Well, and I'll keep it short because I know
Cool.
we've got other questions. But speaking to what both Bryan and Lonnie said, like what we're seeing is you've got to be careful not to overpay for that. And as Lonnie highlighted, where we're seeing the true value adds in those secondary and tertiary markets are not necessarily where you've seen rent growth for the last 6 years. You see two turns, you see something that hasn't been touched maybe, or maybe it was touched once, and then it's been another 4 or 5 years where maybe rents are growing, but you're not seeing it actuated at the property. I don't know if that's a verb. It's not effectively happening, and you're not. By the time those type of properties have typically hit the broker circuit, you're probably already overpaying. You've got to be careful about that and scrubbing those. Looking as an underwriter, banks are now not just accepting the appraisal for what it is. They're actually asking the underwriters to go and search the market, make sure it makes sense compared to the competitors. So if you're the last ones in the market to do this type of activity, I'm not going to say you're too late because you can still capture it, but you've just got to be really careful. So
So,
I think
so what,
something.
Shane? One thing that you hit on that I'd like to sort of toss out there for everybody. Um, I I feel like the risk premium for equity over debt is narrowing more and more and more. Obviously, debt has gone down as a result of rates going down, but I think the equity has sort of gone down as well. And I don't have any statistics to back it up other than my guts. If I'm wrong, feel free to correct me. But I'm really curious, like Lonnie, is this a result of all these funds that were raised and people just want to make the fees and not give back the money, or like, and ultimately what happens here? I mean, even on the residential side, you see the iBuyers come out, but now Rocket Mortgage said they're going into iBuying, where they just like throw out prices that seem to sort of what the market would otherwise bear. You see the single family residents, the SFR pools becoming popular, and then just on a deal, it's like, you know any deal that's marketed, more often than not, it's it'll go at a very crazy high price. And I'm just curious, if has risk lost its meaning as a result of the so many avenues of capital available at such low prices. And if that's the case, and I don't know that it is, um why haven't we learned from the past, or is it that we've learned that we could will everything to recover quickly?
I think those are very interesting questions, and I don't think any of us today probably have the full answer on that. I think it's interesting when you look at risk. How do you define that when properties are not being foreclosed on, when people are not being evicted, when the market that's set up to have remedies in place when people can't meet their obligations are not able to be exercised. And so it makes that risk component a little bit ambiguous. And so I think people just don't know exactly what to think, but the capital is available. And so that makes people bullish. I mean, if you've been on Twitter in the last, 9 to 12 months, the amount of folks that are, in the shadows advertising their GP status and taking LP funds is crazy. And folks that have never been a GP in their life have access to capital, and they're having to place that capital in deals that they probably don't fully even understand. So I think we're going to see we're going to see very quickly. I think in the next 18 to 24 months, you're going to have markets that are completely upside down. And then for the folks that have been through this, that have sat back with their capital and been patient, they're going to come in just like they've always been able to and buy stuff, at a fraction of the real value. And that's where the real value add play is going to be.
Now, Lonnie, you're coming into my wheelhouse, but I'll round out my point on this. Two things. Number one, Lonnie, welcome to Clubhouse, because what you're going to find out is a lot of what you don't see, you can get here through stages like this. Like, it's really the ability to get a lot of integrated perspective on the whole ecosystem of real estate. The second piece of the puzzle that really bothers me in this whole equation, as I've talked to many operators and I've met even more on Clubhouse, you take West Michigan, for example. Okay, you've got the RPOA, which is the Rental Property Owner Association. I'm very familiar there. Then you have PAMWAM, which I did some stuff with. RPOA is 1,500 landlords, but there's also like a lot of operators that have like, say, 300 to 2,000 units. PAMWAM is mostly the big boys. Like, I've got a guy that I mentor that's with Alliance Residential. He's one of the youngest vice regionals to come into play there 4 years ago, and that's like 85,000 doors. Whereas RPOA is probably I don't know, 10 to 20,000 doors. Those smaller operators in the 300 to 1,500 door space are really being pushed by these GPs to give them, great rates and, all this different stuff that's really not sustainable for them. But because of economies of scale, they can't afford to take out 100 or 200 door, thing out of their book when it's probably anywhere from 10 to 20% of their business. So they go ahead and they accept all of a sudden a 5 or 6%, management fee, when they don't really, they've come from New York, they've come from California, they don't understand that the performance matrix is totally different. So it's just one more piece of the puzzle that's going to be really, really troublesome as far as, getting that performance and even getting that management. And I'm super concerned about how this is going to affect the people living in those spaces. But I will tell you, Lonnie and Stacy and Shlomo and Bryan have witnessed the power of this, and maybe Jeff a little bit over here, that, if you curate the right people, get the right conversation, on Clubhouse, we've been able to kind of be a little bit in front of the trend, and get a little bit more clarity to the fog by just having great integrated conversations with brilliant minds in Clubhouse, like some of you guys that have just brought on today that Shlomo's done. I think he's done a great service to the app and to the real estate community by having this conversation. I will take 2 seconds to tell what Shlomo doesn't do a good job of sometimes because he's busy. This is Shlomo and the CRE Club. So follow these guys to get more great conversations. But fantastic stage, Shlomo. Thanks. I wanted to get some clarity, and I noticed you had something to say, Bryan. I'll round up my part of it.
No, and I think what everybody is saying makes total sense, and I've been through lots of cycles. I worked for the RTC in 1990, and that was my first cycle. And as a young guy, I got to see cycles, and the key to real estate to me is longevity. That over a 10 or 20 year period, you almost always do well, but over a 3, 5, 7 year period, you get crushed by cycles changing, and most people don't have the capital to hold through the cycle if something goes wrong. But I think that we're in an interesting place right now because there's so much information, there's so much capital. I've never seen anything like this in my lifetime, where there's almost over information, where it's not a problem. It used to be you got burned in real estate because you didn't understand the market or you didn't have the right information. Now there's people like Trepp and so many data sources out there that provide tons of data that that's not the issue anymore, and access to capital really isn't the issue. So it is. I think it's going to come down to the skill of the people that are operating the properties, and the ones that aren't skilled are not going to survive.
Thank you, Bryan. I'm going to want to touch on something else over here, but and specifically with regards to some of the forbearance deferrals and the repayment plans and what we're seeing moving forward, Lonnie. But before I do go over to that, Jeff, it's good to see you again, Jeff. Please introduce yourself, and how can we help you?
Yeah, thanks for having me up. My name is Jeff Brand. I own a company called Brand Partners in Dallas, Texas. We focus on buying strip centers, retail properties, 10 to 30,000 square feet. And Bryan, you talked a little bit about the lack of interest on the CMBS market in retail. And I was wondering if you're seeing any bifurcation on that with regards to a mall, a power center versus strip center, because I see as you read in the Wall Street Journal about how bad malls are doing, and a lot of my investors who are not doing this every day think that all retail is bad because they read about malls. So I'd like to hear you speak about that, strip centers, and Lonnie too, because you're monitoring all these types of things. But and we're buying a new property in Louisiana next month, and we're getting traditional loan from a regional bank on it. So, and Bryan, you said as debt's dried up, but we're not having an issue on these unanchored strip centers, and ours are mostly mom and pop tenants. So I'd like to hear y'all's opinion on that. And I bring it off the apartment and multifamily a little bit, but I'll just stand by and listen. Thank you.
No, and you're 100% right. And I apologize. I mean, sometimes we speak in generalizations. And, my nephew is actually a triple net broker, and he's had phenomenal years the last 2 years because there's a lot of capital out there, and so triple net assets represent safety, and so that the triple net retail side has been insanely active and maybe in some people's views overactive. The retail strip center side is coming back strong. We're seeing more and more CMBS activity. We're still seeing regional bank activity. It's really a tale of what you have and how you did during COVID. Again, lenders always tend to try and look backwards, and so they're looking at properties that performed well throughout the downturn, and those properties are still able to obtain capital. And it's just a much lesser market where you it's much harder to go in and do a bridge loan for somebody to renovate a retail center unless they have a very, very detailed and specific plan, and there aren't a lot of moving pieces to the retail center because a lot of people are just afraid that some of the big boxes are going to go out, that there's going to be continued disruption, and that there's just more space than there are or there's more space than retailers. And so that's been the concern on that side of the market. But I agree with you. The malls are the big problem. The malls are where we've seen all the real problems in the market. But I think it's been translated to somewhat certain centers. Like if you have a big box center, those are much harder to do. But the traditional strip center is still hot. And then triple net properties are very hot. And one strategy we're seeing a lot of is people buying, the traditional retail center, taking out the two or three good credit tenants if they can, especially if they're on a pad, and selling those off. We've seen tons of those strategies. So retail is still active. It's getting overshadowed by multifamily and industrial because it's such a large growth spur in that part of the market.
Thank you. Jeff, did you have a follow-up?
Yeah, another thing you mentioned I thought was interesting was, you know, the you had mentioned that there's so much information now, and I find that, and this goes back to the discussion of yields and being able to exit and make money for your investors. And I find that certain GPs or promoters, whatever you want to call them, sponsors, if you can utilize data to your benefit, and with so much data out there, you can manipulate it so that so the equity investors and the lenders, it looks good on paper, but in reality, it's not a great deal. I mean, we look at things real simply. If we can't do it on a piece of paper without using Excel, even, it's probably not, and it won't pass our initial uh, look at it. But do you see that happening too, where the use of sophisticated data and manipulation of cash flow models and things like that are getting people to even worse deals?
Yeah, I think so, and I think especially like on the crowdfunding side and some of the other, like I've never seen more beautiful packages and information that you see when people are going out for crowdfunding. But if you read the details of what the investors are actually getting, they're getting horrible returns, much worse than they could get going into just a regular private fund. So there is something to be said that there is this oversaturation of data that can lead people in the wrong direction, and we're seeing it in our industry. Like there's so many companies that are raising huge amount of monies because they're no longer loan brokers. They're finance companies that are using technology. They're fintech, and now people want to give them millions of dollars to do things that they have no experience doing. So it's an interesting place. And Lonnie, I'm sure on the Trepp side, you're seeing, that, more and more different tools that you guys are creating, that people are using them in different ways than you guys ever expected.
Yeah, it's interesting. I think data on its face doesn't really tell the story. You have to be able to utilize the data, transform it, make sense of it, apply it to your application. So it's interesting. I think to your point, Jeff, a lot of people can take anecdotal components of the data and kind of tell a story that they want, which may not actually translate into performance. But I do think for those operators or those GPs or those folks that are in the business that want to, they can take the data that's available now and make it a huge competitive advantage for them in ways that they maybe wouldn't have been able to 10 years ago just because of the lack of availability of data. So I think the CRE market in general, would have been best described as an opaque marketplace relative to data 5 to 10 years ago. And I think the data is becoming more and more commoditized at this point to where you have to add, like for us as a vendor, you have to add additional service component to that so that you can stay competitive with the market landscape. But the data itself, there are a lot of vendors that have a lot of really cool tools and availability of information that give you insights when properly used can really give you a competitive advantage. But I would agree that sometimes, the lowest common denominator back of the envelope is what you need just to see if something passes muster or not on the front end.
It's very interesting, and I know, well, sometimes, okay, Brian, you alluded to mortgage companies that are so saying they could do things with data. I mean, WeWork was a tech company, right? But the reality is, it wasn't a tech company. It was just packaged as a tech company. So, I mean, as someone who got into prop tech on the mortgage side in 2003, I've been very active since then, advising multiple parties. I could tell you straight out that there's a lot of official data out there that isn't really data. And data is garbage in, garbage out. So if you take CoStar, for example, it's updated by individuals. Sometimes you get the info, sometimes you don't. You take someone like Trepp. Trepp actually, it's mandated in the docs, and people are getting paid big money to compile this data. And then Trepp actually internally then goes and synthesizes it even more. So that's where the data gets processed and the data is worthwhile. But when you have data and you interpret it by running queries, and you can't interpret it properly, because you're not, you don't have the experience to see, okay, if this, then that, right? You can do the if, you could do what happened, but you can't look forward to the future. You can't identify the variables and the differences. It becomes an issue. So, Stacy, I know you're going to have to jump in a second. I did want to get to another topic, but before I do that, can you talk a little bit about how you interpret data based on the information that's on the ground, both, on in all aspects of your business? Like, what's the right way?
We we as Lonnie said, we don't look at it from a face value perspective. We always ask why. You'll hear me talk about the 5 pillars, my 5 pillars, specifically with regards to underwriting or evaluation of a deal. And those 5 pillars are market, property, tenant, sponsor, and structure. And if you can look at the data and how it interweaves in those categories, i.e., what is the supply demand telling you in the marketplace? What is, how does that filter into the property's position within the market, the condition in the market? Getting back to what Lonnie said about office, one of the things you haven't heard a lot about, granted, with everybody pushing the dates to come back now with all the new Delta variant and everything, I think you'll see more of it. But, we didn't hear a lot about that. We heard about retail, we heard about hospitality. Right away, we started to see issues, or I think we're going to see, because I see the deals also on the CMBS. I underwrite for BP Spires as well. And so what you were talking about, Jeff, you were talking about on the retail front, and proceeds and markets and strip versus mall versus power center. It's funny, the power center is not the little doll anymore now that we've been through COVID. But what you're saying, Shlomo, back to the data itself, you have to look at how it interweaves and if there are any type of leading indicators. Or, I'm thinking about some agency CMBS we were underwriting this week, securitization for BPs. I was immediately training some of my new analysts on how to look at what bad debt is going on and how to go find those delinquency reports and how that's going to impact collections. So, you see a property continuing to feed through, to look like it's doing well, but you don't see the fact that the money is not coming through because of the delinquency factor. And then all of a sudden, boom, you see a big, huge bad debt number in January. Guess what? That was because there was like a 5-day period where people didn't have the moratorium extended, where some judges actually said, okay, it's time to alleviate, this situation where with people that were not cooperating, that we're taking advantage of the system versus those that were really utilizing the resources. I think we've seen, oh golly gee, I just completely got off. I could go in so many different directions with this, but data. I think it's just so important to dig a little bit deeper and make sure that you validate it. It's like the two-step verification point we all have for secure things now. Make sure it makes sense. If you've got GPR showing a certain way and a rent roll that's showing a certain way, see if you get the bank statement that shows the collections were coming in that ties back to the rent roll. Get the delinquency report that ties all three together. Make sure that it all, and I'm talking about a granular level property scrub. I mean, you can back that up, and you can talk. Like I use Trepp data to look at things from a property level to a market data to originations that are going on and pricing. It just depends on how you stratify it. And the most important thing, and we talked about this at the Globe Street Women's Conference, is you got to understand how clean that data is, aggregating and cleanliness of the data, so that you at least know that no matter how you're manipulating it, you can depend upon it. So
Got it.
with
Thank you.
that, forgive me, I got to
Yeah,
drop.
no, no, I appreciate you joining us, and we'll chat soon. Thank you so much. So,
Thank you.
Lonnie and Bryan, I don't know how much more time you have. I want to dig in on one thing if you can. Otherwise, we could wrap it up.
I can stay on a few more minutes, Shlomo.
Got it. Um, okay, so one thing I wanted to touch on is the results of COVID and how that's going to play moving forward from a restructuring perspective. So, as many people know, when owners had issues with their loans during COVID, they went to the lenders for some type of relief, and the most popular form of relief was the forbearance and deferral. Essentially, forbearance meaning that we will not go after you in court for this default that's happening right now. And number two, we're going to defer the payments that you're making now towards a payment schedule down the road, which means essentially that if, let's say, you have to make a, I don't know, $100,000 payment this month, and let's say there's no money coming in after expenses, so we're going to take that $100,000 and put it in this account, and after, let's say, 6 months or 12 months of you not paying anything, over the next 24 months you will pay 1/24 of the money that was not paid to that time, right? Now, often what lenders did, they required a personal guarantee on the deferred amounts, which usually CMBS is a non-recourse. I guess my question, Lonnie, is like this. At the time, I believe Trepp's delinquency rate was lower than what was actually happening, because these forbearance deferrals did not show up as a default, as a late payment, was paying as agreed, so it may not have shown up in the statistics. Obviously, now, as people are paying and people are coming back to paying, the delinquency rate is still there. But the where there is a difference is that now your debt service payment is actually larger, so therefore your coverage ratio on an ongoing basis would therefore be lower, right? Because if your reported coverage ratio is, let's say, a 1.25, and that's based on a mortgage payment of $100,000, and now you got to pay 1/24 of $100,000 times 12 months, tacked onto that, so your coverage ratio will be less, which means that there won't be enough cash flow from the property necessarily, or not as sufficient to cover the new catch-up payment, if you will. So my question is there any surveillance you're doing on that end? What are we seeing? Are you hearing anything where people are defaulting on some of these deferrals? And if you really don't have any data, do you have any other data points you may be able to bring to bear to sort of give us some indication as to where you think this is going?
Yeah, I think those are great questions. So I have a little bit of information that I can share with you guys on that. So I think your first point, we were referring to the forbearance deferrals as effectively shadow vacancy, almost like you would have, I'm sorry, shadow delinquency, like you would have shadow vacancy in a down office market or something like that, where we know it's there, but it's just not necessarily showing up in the numbers for various reasons. And so a good example of that would be if you were a hotel operator and you requested a forbearance, they would let you pay the mortgage for the first 3 months out of your FF&E reserves, and then, as Shlomo detailed, you would add on recapture of that, plus any future missed payments into some sort of a repayment schedule. So, but even with that, even with those programs in place, let me give you some numbers to kind of, blow your mind a little bit. So, January of 2020, pre-pandemic, hotel delinquency was sitting at 1.38%. You fast forward 12 months to December of 2020, and the hotel delinquency in the CMBS market was at 20.21%. If you look at retail, January of 2020, it was at 3.58%. Fast forward to December of 2020, it was at 13.04%. So even with those shadow delinquency numbers not being reported, the amount of known delinquency was still astronomical relative to the historical norm. If we look at where we're sitting, the end of this last month, end of July, hotels had come down to about 13% delinquency. Retail was down to about 10.5%. And what's interesting, and it kind of goes back to what Shane was mentioning earlier, multifamily throughout this entire thing has been, sub 3%. But as of July of 21, we're up to about 4.5%. So just as a proxy, it was at 169 in January of 2020. It's at 4.52 in July of 21. So I think what we're seeing is, some markets have recovered. Hotels and retail properties are doing better than they were at the peak of delinquency. But still, from a historical perspective, it's still, 3 times as high as it was for retail and about, 8 times as high as it was for the lodging sector. So, I think the distress is still out there. I think it's going to start showing up. I think that as these forbearance deferral programs wear off, to Shlomo's point, adding additional debt service to a property that's already skinny on a debt service coverage ratio is not an ideal equation. And so some of these properties aren't going to make it back. I think what they've done is the proverbial kick the can down the road. And here in the in the near short term, we're going to start seeing some of those properties just not be able to make it, and they're going to run out of lifelines.
That's great. Thank you. Brian, I'll let you get your feedback on this. But if anyone has any final questions before we wrap this up, please feel free to raise your hand and we'll bring you up. So, Brian, I guess the question is, I mean, what are you hearing anything from your clients with regards to their recovery from COVID and getting back to where they need to get? I'm assuming, there's some people on the refinance side that are looking for it, and you're seeing some financials. Are you seeing some people trying to potentially avoid the issue of getting out of loans? But do you have any other data you could share with us, sort of in your discussions with your clients on this topic?
Yeah, I mean, in a way, I would agree with Lonnie. I mean, yeah, I think the whole key is, where the market goes from here, because, if it stays hot and these distressed properties start coming on, that they'll be able to sell off at, somewhat values to recover. But I do think, I have some hotel sponsors that it's miserable right now in certain markets where, COVID is still going strong. The business market hasn't come back at all. So if you have like a downtown hotel that had done fairly well, pre-COVID, you're nowhere near where you were, you know, 2 years ago or 3 years ago. And yet now you not only have your current debt, but they usually gave you about a year period. So now a lot of times you're starting to pay back, the deferred debt as well. So you have almost like a double payment or payment and a half, and you have income still down. So those guys are going to have deep problems. And it's just figuring out, is the market going to save them by being good, or is it going to start to decline and they won't be able to get out of these assets?
Very interesting perspective. I really appreciate it. So I guess in summation, what I heard today, and if anyone has any final comments after this, Lonnie or Brian, so what I heard today is, be careful what you buy, be careful how you finance, understand the difference between the lenders, how they're going to deal with it. Um, but I think the one point that sort of brings this all together is that when you take your loan, you need to negotiate your loan documents with an attorney that has been there, done that, and also been involved in negotiating modifications on the back end. Like, I cannot begin to tell you how many loan docs I look at that just are absolutely awful, where the attorney did not understand the implications of what they've agreed to. And it's not just the attorney. When you negotiate a term sheet, that term sheet becomes the Bible that the attorney reads from. So you need to make sure that you negotiate the term sheet and not just like try to get it through just so you have it done. because yes, you'll get a deal done, you'll make your acquisition fee or whatever it is, but it could rear its ugly head down the road. So, in summation, I think it's about understanding your property, understanding your market, but also understanding the loan you're going to take and the implications of that loan moving forward. So, Lonnie or Bryan, if you had any final thoughts on the market or anything that your respective companies have going on right now that you'd like people to know, please feel free.
Yeah, I would just say if you haven't checked out the Trepp website or read any of our research or publications, you should do that. We put out a ton of free content that gives you some really good insight into the market. So definitely check that out. And I know some of the tenor of this is, talking about distress, and it maybe comes across as a little bit negative. I'm still very optimistic about CRE as an investment vehicle into the future. I think it's still going to be the best investment option for a lot of folks. But I think, as Shlomo said, you have to do your due diligence, and that's both on the front end from the acquisition perspective and pricing, but also in the instance that there is a downturn, make sure that you've contemplated that as part of your due diligence as well, because nobody likes to underwrite downturns in revenue or increases in expenses, but if you don't at least have that in your consideration, when these types of disruptions happen, you can be really, caught in a pickle. So very, very appreciative of the opportunity to speak on this today. Thank you so much. And if I can be of any assistance, feel free to reach out to me via LinkedIn or any other medium. Thank you.
And I'll add, thanks everybody for listening. And I agree with both Shlomo and Lonnie. I think there is a lot of great potential out there, and I think there's so much information thanks to people like Trepp that makes this process better. And I also believe, as Shlomo said, that you have to hire the right people. I would say the right loan advisor, someone like us, the right attorney, because we've been through it. We understand where all the pitfalls are, and a lot of times, people that are younger and haven't been through 2 or 3 different cycles don't understand what can go wrong in a loan. It all sounds great when somebody's giving you a lot of money, but there's always ties to that money. So I always warn people, whether it's debt or equity, anytime you get money, there's plenty of people that'll give you money, but you want to get money from the right people, structured the right way so you don't run into trouble and it doesn't, like Shlomo said, impact you in the future. It's not good to get a big chunk of money today and go out of business tomorrow. So it's just being smart and having the right people around you and finding people you trust that can lead you in the right direction.
Yeah, and just to wrap up that point, it's not necessarily that you need to account for a downturn in the market like a COVID or a great financial recession, because those are impossible to account for, although they've happened more often than we'd like it to happen, but nonetheless impossible to account for. But anyone who's experienced in operating property or financing and dealing with people that operate property know that properties don't just operate on a straight line. There's ups, there's downs. There's a tenant that needs additional space that would encroach on another tenant that would cause an issue that needs lease modifications, that needs incentives given, and there's an approval process, right? And I mean, just in taking that as example, if you don't put deemed consent in your loan documents, that if it isn't granted within X amount of time and the lender is taking a long time, that it's assumed to be approved, you just potentially lost the lease down the road, and that's a massive issue in CMBS. So these are things that you really need to have the right parties at every step in the way, like Bryan said, from the time you get the term sheet and work with the lender to the time you execute it and move forward, and also your local management on the ground, that they could understand how to deal with a lender, with the servicers. So these are all issues that need to be dealt with, and I'm always glad anyone that wants to reach out to me, follow me here on the app. I'm here often, and follow the others as well around you, because this is how the app curates rooms, notifies you of rooms if the people around you are in a room. So make sure to follow everybody, and you could reach out to me with regards to anything on the loan asset management side and the stress side, and be glad to sort of answer any questions anyone has. So with that, I thank everybody for joining us. Thank you, Stacy and Absentia. But thank you for coming. Thank you, Lonnie. Thank you, Bryan. This was really great. And thank you to the many people that joined the room today. And have yourselves a great weekend.
Thanks, Shlomo. Thanks, everybody.
Thank you. Bye bye.